Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let market update. How are you keeping? Well, I hope. All fine here. 3 more days of homeschooling, which can only be a good thing, both for myself and my son. Be really great to see the children go back to school next week. I think it's an interesting time at the moment. I think we've all been really hankering after going back to the good old days, but now we're kind of faced with it and the return to kind of more normality. I think a lot of us are actually feeling slightly apprehensive about how that's really going to work. So, if that's how you're feeling, you're really not alone. I'm feeling the same way too, slightly in trepidation about the whole thing. But you know what? I'm sure everything will be absolutely fine, and we'll settle into another kind of way of working and another normal as time goes on. Now, look, in terms of what we've got for you today, we're going to have a lender update as always. There's loads of news to go through with you there. We're also going to just touch on an explanation about the move from Libor to Sonia, which some people may or may not be aware of, but actually I think it's worth explaining because a large number of our landlords actually have mortgages which have been on Libor rate, and you will be going through this change, so we're going to cover that off. And then lastly, I've just got some data to share with you with regards to some landlord sentiment, which is always really, really interesting to hear. Now, today's Wednesday, it's budget day. We're not going to be covering off the budget in this video. The reason being that, first of all, it's 8 o'clock in the morning and the budget hasn't happened yet. And as much as I like to think I have superpowers, I'm actually not psychic. But also, we really want to keep this video to being just letting you know about real market news. So actually, we're going to cover off the budget and the implications to our landlords in our investor update newsletter, which you may or may not have subscribed to, but I really would recommend subscribing to it if you don't. Because it's full of really useful content. So in terms of lender activity in the last week, there's been another series of repricing downwards, which is really good, obviously. In terms of why we think we're seeing a lot of repricing at the moment, I think it's fair to say the market has been going through a period of change. If you sort of cast your mind back, in the run-up to the stamp duty holiday being announced, pricing has started to come down. Then the stamp duty holiday got announced, lenders got absolutely bombarded with applications and pricing started to go up again. Lenders will cite the reasons for this as controlling business volumes. I absolutely think there is a truth in that. I also think there's an element of being commercial. Actually, why not charge more when you possibly can? Ultimately, these guys are businesses at the end of the day. But now things are starting to tail off again. The lenders are clearly coming back out and relooking at their pricing and bringing their margins back down. So I think actually we are seeing repricing now, but I think we're also going to continue seeing this over the coming weeks and months as lenders really kind of look to establish their pricing models to sit in line with whatever the market is doing going into further into 2021. And I think a lot of how the market's going to react is obviously going to be driven by the announcements in the budget this afternoon with regards to the stamp duty holiday. So watch this space. So in terms of what we've seen in the last week, first of all, Vida Home Loans have reintroduced their 80% loan to value products. Rates start from 3.94% for a 2-year fix and 4.44 for a 5-year fix. So pretty toppy there. But, obviously having an option in the 80% space is always to be commended. Now, these rates are available for single dwellings only. It's available on their Vida 1 range, which means that it's for those people with very, very good credit profiles. Vida are certainly able to consider those people with imperfect credit files, but it wouldn't be on their Vida 1 range and you wouldn't be able to get 80% loan to value. Now, they've also reduced their minimum loan size to £100,000. So it was higher than this. Again, they pushed the minimum loan size up to try and slow down business volumes. They've calmed down a bit now, so they've reduced the loan back down to £100,000. Now, what else can I tell you about Vida Home Loans? I mean, look, with them, you can have up to 20 mortgages, up to a lending amount of £4 million. They don't mind how many properties you've got in the background. They don't have a minimum income requirement, and they do accept let to buy applications. Now, let to buy is a bit of a industry jargon type term. Let to buy is the process by which you are letting out your current house and putting a buy-to-let mortgage on it, and then buying a new main residence. So the let to buy mortgage would be the one on the property which you're retaining and renting out, and the new property which you're moving into would be a standard residential mortgage. Let to buy, I mean, they're not special products. Lenders either do them or they don't do them. There's nothing particularly complicated about them, but not all lenders will do let to buys. Great to see that Vida are able to do these kinds of transactions. Other points to note, they do accept ex-local authority flats and they do accept deck access subject to valuer's comments, and they can lend to first-time buyers. So buy-to-let mortgage for a total first-time buyer. Look, there are other lenders who do this. They all tend to work on the same premise where they will underwrite the mortgage based on personal affordability, so essentially like a homeowner mortgage rather than on the rental income. Now, we've also seen Barclays make an interesting announcement, and this is more in the resi space, but I thought it was just worth a mention because I think it's quite interesting. But now what they're saying is that people who have a residential mortgage with Barclays are able to let their property out on a short-term let basis. Now, there are some terms and conditions that sit around this, but as long as you meet those less short-term letting conditions, you don't actually need to get their prior approval to do so. And I think for those people who potentially are thinking about renting their own home out on an Airbnb basis, just occasionally, this could be a really good solution for you. Now, Barclays have also released 10 new buy-to-let rates, which start from 1.8%. And their product pricing, they tend to either have a flat arrangement fee, which can be up to circa £2,500, but they also have products with no arrangement fee at all. And their remortgages do come with free valuations and either free legal work or £500 cashback. Now, my advice to you, if you are thinking about doing a remortgage with Barclays, and this would apply both for your own home or for a buy-to-let property, take the cashback and use your own solicitors. My experience of dealing with the Barclays solicitors, and I'm not alone in this sentiment, is that it's not a great experience. So, you're much better off taking the cashback and engaging your own firm. So look, if you want to get a buy-to-let mortgage with Barclays, you can have no more than 10 properties in the background. They're only lending to individuals, so no limited companies, nothing fancy there. And what they do is they always assess their affordability, as it were, on buy-to-lets on an overall affordability model. So it's quite complicated. And I think personally, I don't particularly like doing buy-to-lets with Barclays because I don't find the kind of appetite and credit risk approach particularly transparent. But I think, rest assured, if you are a landlord with a good, strong personal income and one buy-to-let in the background, the chances are they're going to lend to you. So there is a real place for them as well in the market. But I think really for those people with lots of buy-to-let properties, probably not the best lender for you to kind of go with. It wouldn't be a good marriage. Now, to have a buy-to-let mortgage with Barclays, you do need to have income of £25,000. This cannot be from rental income. Now, what's really interesting on this, actually, just to say, is that if you wanted to get a residential homeowner mortgage with Barclays, they do accept rental income. They're actually a very, very landlord-friendly lender when it comes to homeowner mortgages. So it's a little bit at odds with each other, but, it is what it is. Now, they will accept first-time landlords, and they do allow people to rent properties to companies, DSS tenants, and also housing associations and students. Now, any non-individual lets, so the corporate letting type arrangements and housing associations, are going to be subject to a maximum lease term of 3 years. Now, Barclays do accept ex-local authority flats. They will accept deck access, but no studio flats, and you can be up to age 80 when you apply for a mortgage with them. So actually, in the round, a really solid proposition from Barclays, but like I say, I just find them quite fiddly and, not transparent in terms of kind of where their appetite sits when it comes to affordability. Okay, so we've also seen Landbay launch 4 new 75% loan-to-value products for non-portfolio landlords. And in the context of this product, what they mean is that at the point of application, you can only have 3 or less properties in the background. Now, that definition of non-portfolio is very different to the standard industry definition of portfolio landlord, which would be 4 or more distinct mortgage buy-to-let properties. So apologies that that's slightly confusing. But so a non-portfolio product for those landlords with 3 or less properties at the point of application. The rates start at 3.14%, which particularly in the limited company space, and these rates are available for individuals and limited companies, is actually very competitive. And these come with a maximum loan amount of £1 million. Now, they've also got a series of other special edition products which are available to everybody. And these rates start from 2.95% on 2-year fix and 3.34% on 5-year fixes. And these are available again to limited companies or individuals. Now, on these products, you can have up to 5 mortgages with Land Bay and no maximum number of properties elsewhere. We've also seen West One make some price reductions of 15 basis points on both their short-term let offering and also their expat range. Now, it's just worth mentioning that West One only let certain brokers access their short-term let and holiday let offering. I'm glad to say that we're one of them. It would be weird if I was talking about it if we weren't. So essentially, the holiday and short-term let rates are now starting from, for holiday lets, 4.19% with a minimum property value of £100,000, and the expat rates start from 4.09% with a minimum loan amount of £50,000. Now, it's worth mentioning here that for expat mortgages from West One, you have to have a buy-to-let property already, so they're not doing this for first-time investors, but they will do this under personal or limited company structures. We've also seen LendInvest launch some 5-year special edition rates ranging from 3.29% loan to value at 3.29% fixed at 65% loan to value, and 3.49% at 75% loan to value. And the maximum loan on these products is £1 million. And these are available to limited companies and individuals as well. Now, for LendInvest, there are no maximum number of properties in the background. These rates, particularly that I'm mentioning, are available only on standard properties, but they do also have an offering for HMOs and multi-units, and they don't have a minimum income requirement. So lots and lots of movement in particularly the specialist end of the market. You will note that the noise from the sort of more vanilla lenders is very, very quiet at the moment. Having seen that, we have seen the Leeds Building Society reduce their pricing, albeit marginally. And we've also seen Foundation Home Loans reduce their buy-to-let rates by up to 20 basis points, with pricing now starting from 2.89%. Lastly, one other change to mention, Precise have increased their minimum loan amount to £75,000, which has gone up. The reason they're doing this, no doubt, it will be largely linked to business volumes. They're going to be getting it's interesting, actually, particularly in the limited company space, the number of lenders who will lend on much lower value properties is quite small. And so those lenders who are in that space will find that they tend to get lots of applications coming in on those lower value properties. And as a lender, you don't particularly want to be exposed in one area. So you wouldn't want to do a large percentage of your lending on very low value properties, but likewise, you wouldn't want to do a large percentage of your lending on very high properties either. So you become too exposed in one end of the market or the other. So I imagine what's going on here is Precise have simply received absolutely loads of applications for those lower value properties, and they're looking at their book and feeling they're a little bit vulnerable, and so looking to just kind of tick the average property value up a little bit to redress the balance. Okay, now you may have seen some talk about Libor ending and being replaced with SONIA. You may have seen in the press, you may have seen it if you actually have a mortgage which is linked to Libor, either now or in the future when you go on to the lender's standard variable rate. I think it's fair to say that, particularly in the specialist end of the market, the lender's reversion rates are more likely to be linked to Libor than they would have been if you were borrowing off a kind of clearing bank. But the key message here is that actually, look, Libor is disappearing at the end of 2021, and most UK lenders are now transitioning to a new, what they're classing as a risk-free rate known as SONIA, which is the Sterling Overnight Index Average. Okay, so look, what is Libor first of all? Let's just start with the beginning. So Libor is the London Interbank Offered Rate, and it's a measure of the average rate at which banks are willing to borrow wholesale unsecured funds. Now, it is administered by the ICE Benchmark Administration, and it is calculated based on submissions from selected panel banks, and is published in 5 currencies and a range of tenors. So in terms of why we're seeing Libor disappearing, I think it's fair to say that there has been some fairly well publicised manipulation of Libor after the global financial crisis, which has obviously given Libor a fairly bad reputation. But in addition to this, there is a dwindling number of interbank borrowing transactions, which has caused the regulator to really question Libor's future. So to give you a guide, there were only 15 interbank lending transactions of an appropriate tenor and size in 2019 for Libor setting purposes, which is really hardly enough to be able to produce reliable industry benchmarks. So accordingly, the regulators have decided it's appropriate to move away from Libor towards a risk-free rate, or RFR. And an RFR rate is a rate of return on an investment with zero risk of financial loss. So SONIA, which is administered by the Bank of England, is the chosen RFR for sterling loans. So what is SONIA? So SONIA is a rate based on actual overnight interest rates in active and liquid wholesale cash and derivative markets, which makes it more robust and less volatile than Libor. Now, it's also virtually risk-free, as it does not incorporate any credit risk or liquidity premium, which is definitely inherent in the calculation of Libor, because Libor is predicated on banks lending to each other over longer periods of time. Now, I think in terms of what this means for you as a borrower, particularly if you've got this change to SONIA coming up, I don't believe it's anything to be feared. Actually, SONIA is arguably safer. As I said, it's a risk-free rate. What they do when they're looking at SONIA is they are looking at historical data rather than trying to predict the future. And in terms of, I guess, the other question I'd be asking, if I was in your shoes, is this going to mean that my mortgage rate's going to go down or up? And actually what we're expecting is that you will not see any material difference in terms of, financially, whether you benefit or lose from this. We're expecting it to be a neutral position for you. Now, it's also just worth noting that some lenders are not choosing to use SONIA. Some lenders have actually chosen to move to a Bank of England base rate linked model. So not all mortgages which are Libor linked will be going to SONIA, but I hope that explains a little bit about what it is. I know it's all quite confusing when you get these letters through in the post and we're using these kind of terminologies which don't necessarily mean a huge amount, so I hope that helps to explain it for you. Lastly, for this week, I'm just going to share with you some of the findings from the Aldermore Mortgages Landlords Panel Regional Snapshot for the South East of England. And the reason I think this is always really interesting, and this is something I've heard from numerous landlords, is that actually being a landlord can be quite an isolated thing. It's not like you have an office full of other landlords to go and chat and share ideas with. I appreciate there's lots of different forums and stuff you can join to do that. But actually, it's always quite interesting just to hear what your landlord peers are thinking and what their plans are. So in terms of what this report has shared for us, and like I said, this is for the South East of England. First of all, landlords in the South East of England report, 88% of them report profitability, and that's compared to 85% of landlords in the rest of the country. Now, 23% of respondents to the survey had reported an increase in tenant demand. 27% are feeling good or very good about the UK financial market. 5.2% is the average rental yield from respondents in the South East versus 5.4% in the rest of the country. And the average person who applied to the survey has 9.8 properties in their portfolio, with a gross rental income per property of £7,143 per year and an estimated portfolio value of 1.7 million. So in terms of what we're seeing in this regional report, and I think it largely just echoes the rest of the country, landlords are certainly starting to feel more confident about tenant demand, about rental yields, about the ability to let property, about the UK financial market. So actually things are going in a really good direction. What was quite interesting in this report, though, because it's important to give you the bad as well as the good, is that 36% had experienced rental arrears in the last 12 months. Now, that figure to begin with sounds absolutely horrifying, but what I don't know is whether that the tenant arrears included those people who had taken a reduced payment on their rent or a deferred payment because of the COVID issues. I'm guessing it would do. So maybe that number is sort of exaggerated because of partial payments. It also mentions that 37% of landlords had a void in the last 3 months. I think realistically there is a lot of moving going on right now. So I think it's to be expected that actually you would have tenants moving out of properties at the moment as people start to kind of, do that whole, adjustment phase that I think so many people are going through in terms of looking to reconsider their housing arrangements. What we don't know is with these void periods, how long they have actually lasted. So a void period could be a matter of just a couple of days, or it could be for the whole 3 months, and we don't know that. But, like I said, I think it's important to give you the not so great figures as well as the kind of positive ones. But in the round, like I say, a really positive report. So good to see that you guys in the Southeast are feeling pretty good about being a landlord at the moment. And there it is, another week done. The weeks come around very quickly, don't they, at the moment? So, as always, do give us a call if you have any questions. 0345 345 6788, or go and have a look at our website. Actually, yesterday we hosted MFB Live, which was our kind of live landlord event. It was really good. We covered off 3 key areas, so financing multi-units, holiday lets, and also funding refurb and development. And I really enjoyed every conversation that I had with our guests. It was very, very interesting. And the feedback that we've had from people who attended has been really, really positive. They found it really useful. So look, if you didn't manage to attend MFB Live, but you would like to have a watch and hear what got discussed, you will find that we are going to be adding a recording of the event to our YouTube channel. So please do go and have a look at that if you've got some time. Like I say, it would be a good, really, really interesting thing to listen to. So there you go. Enjoy your first couple of back to school days, Monday, Tuesday next week. I know I will be. Have a lovely rest of this week and weekend, and I will catch you next time. Thank you, as always, for joining us.